Hello friends, welcome to Nirmal Bang. I'm Piyush Jain and today we are going to be discussing about economy. Why we are going to be discussing? Primarily because the GDP data has come out for the second quarter and we are seeing a big positive surprise. It looks like a lot of core sectors like electricity, manufacturing, also basically we are seeing across consumption space like cement, steel, production also basically from the perspective of other raw materials, we are seeing very robust activity reported in the GDP data. Also, the imports have grown by leaps and bounds. Financial services doing okay. No major concerns there. A lot of positives, a bit of concern around agriculture, but then a lot of things to talk about. What's really happening in the economy, and is this momentum something which we can actually truly believe that it can be carried forward towards the end of the financial year? I think to understand all of that, let me now welcome our guest today, Mr. Indranil Pan, the Chief Economist of Yes Bank. Sir, welcome to the show.
Thank you very much, Piyush.
So let's start with the first question. And before we even go into the numbers, the my first curious question would be that yes, the GDP data was far ahead than the consensus number. How much ahead was it versus your own sort of approximations or estimates? And secondly, I wanted to understand why, how, because I was looking at the Reuters consensus number, and then I was thinking that how basically such a large positive surprise can come for an economic number where usually very large beats they don't come. So help us understand your thoughts on it.
Yeah, so let me just put this in perspective. Before, actually, we were looking at how to do the forecast for the current quarter, which is basically the Q2. If I'm not mistaken, we had about a 6.7%, which was weaker than the 7.8% of the last year. However, as we looked through the advanced indicators, especially the report from the RBI that the listed companies' profits have grown by almost 28-29%, that really had led us to up the manufacturing GVA by a significant quantum. Even after that, we did miss that number. And when we had produced our forecast, we had a number of 7.1% on the GDP. And finally, the number did come in at 7.6%, with some surprised upsides on the both the construction and the mining sector. The construction sector, to be very specific, in my opinion, is continuing to get driven by the large capex expenditure of the central and the state governments. That's evident in the numbers that we see on the fiscal for both the central and the state governments. And the particular reason for that is most of the central government expenditure as well as some state government expenditure could actually be forefronted ahead of the election period when
Elections.
possibly you would be seeing lesser amount of expenditure. So that's the broad take in terms of the surprise and the extent of the upside that we saw even to our own forecast of 7.1%.
So despite your final estimate being ahead of consensus, there was still a beat, and uh, the RBI estimates also actually were far lower than the actual number. Do you believe that this actually is opening up chances of an upgrade in the next RBI commentary on the GDP?
I would guess that they might not actually upgrade their GDP number immediately because going forward, I can see some amount of weakness coming through into the economy.
Hmm.
Number one, the base effect that was supporting the GDP growth is likely to be waning out. That's number one. Number two, you did point out very initially that the rural sector in terms of agriculture is not doing too well. That is showing up in the MNREGA demand for labor, as well as the fact that the rural wage growth in real terms is just about 1%. So that's not a very healthy sign. And most of the upside that we see in terms of the retail prices on vegetables, unfortunately, don't get translated down to the farm level. So these are some of the factors that can continue to restrict rural growth in terms of the consumption demand. Plus the enhanced risk weightages that has been put out for the personal loans, especially in line with the RBI's worry of unsecured piece of the personal loans going higher, that could also sort of pull in the consumption expenditure, especially for the rural sector as well at the margin for the urban sector. So, given that, I think the confidence in terms of the personal consumption expenditure going forward could be weaker. That's number one. And number two, as I did point out, that the capital expenditures of both the central and the state governments, which possibly was the big enabler in terms of the growth numbers in the first two quarters, can also sort of ebb out. And that to a certain extent can significantly weaken the H2 numbers compared to H1. In terms of our own estimates, initially before these numbers came out, we had a 6.2 estimate for the year as a whole, and that whether has been upped now to about a 6.6%, now more closer to the 7.5%.
Sorry. So that's a major upgrade, almost 40 basis point upgrade you're talking about. Now, before I talk about agriculture, which again will be an extended sort of area where we are going to talk, but before that, I also want to touch upon on the imports and exports. The imports have really grown by a considerable amount. What is that showing to you, sir? Because when I look at the manufacturing, very robust sort of growth happening there. Is the growth in imports good? Is it showing us that the demand is strong? Because all demand parameters, whether those are taxes, GST, credit growth, even manufacturing, consumption numbers, they all are strong. What is imports really telling you?
So obviously, to a certain extent, it is indicative of the fact that the domestic demand is relatively on a healthy ground, and there are imports coming in terms of the electronic goods, basic metals, which also is going to support the investment activity from the government, as we just discussed. But having said that, yes, the other side of the story, however, is that while the domestic demand is good and the imports, therefore the non-oil, non-gold, to be very specific, is relatively resilient, the unfortunate incident is that the exports are actually sort of falling off. And if you clearly look at the data, I think the share of exports, despite talking about all diversification of exports, share of exports to advanced economies continues to be about 35-36%. And that's not going to be the epicenter of growth in the near future, which necessarily means that the trade gap is expected to widen. And from the expenditure side, this trade gap is likely to be a drag on the growth than anything else. And that supports our call for H2 being weaker than H1.
Sure. But sir, in absolute terms, isn't the exports data is almost showing a similar sort of increase what the imports are showing, just in an absolute sense?
Uh, yes, in an absolute sense, yes. The imports are relatively more resilient than, especially the non-oil, non-gold imports. If I leave aside the 7 billion plus import that we saw in gold in the last month, which led to a very severe jump in the trade. So that to a certain extent may normalize. But even if you leave that aside and the crude oil aside, the non-oil, non-gold imports is definitely sort of holding up at this point.
Right. And from that perspective, because we usually talk about that gross fixed capital formation going up is good for the economy, implies that there is investment happening there. What are you making out of GFCF being up 11%? Because I was looking at the private consumption expenditure, that was not showing that sort of robust growth. But here GFCF is going up. So where perhaps this investment could be going, and how do you see actually shaping up as we go some quarters ahead?
I think from the expenditure side, which is basically the GDP, the GFCF has definitely contributed a huge, significant amount. In fact, the GFCF share in the overall GDP on a constant price basis is now almost is higher than 35%. And
Mm.
very critically, it is getting driven by the government expenditures, as we have discussed. You yourself said that you have not seen any significant momentum in terms of the corporate sector investments. Corporate sector investments obviously is looking to the demand side story. And the demand side story remains uncertain both from a domestic perspective and the external perspective. And therefore, on an overall basis, we don't see corporate investments growing. Though sectors that might be very closely linked to the government expenditures, which is also maybe the construction sector, the steel, cement, specialty paints, those could be adding capacity at this point in time. So yes, GFCF is one big enabler for growth, and that if I break it down, it is more government's efforts rather than private sector efforts.
Second quarter has gone by. We are almost now towards I would say, the last part of the third quarter, and then we step into the fourth quarter. Um, as per the cycle seen the last times during the election years, because the fourth quarter will have all the buzz about the elections. Uh, what has been your usual observation? Like, um, has the sort of government investment gone down, or like the consumption has picked up? Like, how we now see the fourth quarter and the third quarter GDP?
So, on a very sort of how should I put it,
Talk your
on a
basis.
on a top of the mind
Hmm.
impact is obviously the government consumption expenditure has to go down, because there are a lot of policies that get into an election embargo. On the other side of the story, there could be some noises building up on the consumption through the currency in circulation, as that we have experienced during any election cycle. So there might be some switch towards the consumption side from the investment sides from a government's perspective, but I'm not sure whether the consumption side can take up the slowdown that we might be seeing on the investment side from the consumption from the government's expenditure on the capital side. So that being the scenario, and along with the fact that there is still some lagged implication of the previous monetary policy increases that flows through to the economy, plus the clear intention of the Reserve Bank of India to keep liquidity tight, should enable, along with the fact that, as we talked about, the external sector where trade deficit is expected to widen, should actually enable a pull down in the growth in the second half, especially in the fourth quarter compared to the first half of the year.
So if the current momentum is strong, but the growth could be slowing down, and then if we actually are looking at very strong sort of sticky food inflation, WPI is also actually not subdued. We are seeing some sort of reasonable WPI there. What's your own sense? How RBI actually would be looking at all of this data?
I think any thoughts for an easing of the policy, even after looking at inflation trajectory on the lower side, especially as we have hit the sub 5% in the previous month, that should be thrown out of the window after we have seen this GDP print. So the
Hmm.
clear message from the RBI should be that the economy continues to be resilient. But the inflation, there's a lot of noise around that. We have seen oil prices going up to 83 and 84, and then suddenly coming down to an 80 or even a sub 80, and then recovering back to around the 80 levels. So, but the supply side shocks, not only from the commodity perspective, but also domestic agriculture needs to be taken into cognizance in terms of the RBI's own sense of a very confident achieving of the 4% central line from an inflation targeting perspective. So unless that is there, there cannot be any talk of interest rate easing, which necessarily means that in the December policy, we are not only expecting a status quo, but even thoughts of the stance changing is possibly not there, and there can still be sprinkling of hawkish rhetorics within the policy, and a clear direction in terms of how RBI stands at top of the economic order, in terms of driving the credibility towards attaining the inflation target that has been set out for itself.
Right. And a word actually I wanted to ask you was also regarding what's happening in the gold prices. You touched upon from the perspective of energy prices. Fertilizer prices have come down considerably. Energy prices more or less have remained same after an initial perk up, but gold prices actually have been quite buoyant. Um, what do you make out from the perspective? Is there any sort of concern which RBI would be having, or this is something which is just part of the course?
So obviously, I think gold prices is something that the RBI clearly looks at, and especially from the historical evidence that we have from 2013, when gold imports had shot up very significantly. I don't think we are in a situation as equivalent to 2013. Simply
Hmm.
because even though the gold imports surprised on the higher side, to a certain extent, it can be in line with the festive demand and the wedding season demand, which might actually cool off. That's number one. Number two, gold prices are determinant of the interest rate cycle in the global economy. Until the point in time, the interest rate cycle was on the bullish side, or rather on the bearish side. I think gold prices therefore were contained, and as the sense we get that the Fed is unlikely to move any further and the US yields have come down, gold prices have once again sort of gained. But beyond this, if we were to accept that the US interest rates of the 2 year and the 10-year variety might not come down below the 4% hurdle immediately, I think the gold can be capped at around 2050 to 2075 for the moment. And obviously, the RBI would be watching out for the imports and may actually keep a clear focus on the gold imports in volume terms. But as of now, there is no fear and worry of CAD even coming closer to the 2.5% red line that the RBI had always been consistently talking about.
Okay, so that was about our economic discussion. I basically can't avoid asking you questions from a stock market perspective. So let me ask you, from the way you're looking at the economy, because you almost look at health of every sector. How's it looking sectorally? Which sectors right now you're seeing strength in the activity as we are currently in the third quarter?
Well, I'm definitely not a specialist on the stock market, if you may know. But even if I attempt to answer your question, I think obviously sectors such as the steel, the cement, specialty
All
chemicals,
construction related.
all construction related sectors should be doing relatively better. The banking sector, I think, is relatively stable, even though the upside may have been limited by the new policies that the RBI has come out with. Probably, given the fact that we are expecting consumption demand to remain weak, so all sectors
Mhm.
that are related to the consumption demand, especially the FMCG and more critically sectors which cater to the rural segment of the economy. Those are the sectors that might actually be in for some sort of derating,
So,
if
sir,
I may
are you
term it.
are you bracing for a slowdown in the rural demand as we move towards the end of Rabi season?
So, rural demand has been weak, no doubt. And if at the margin, personal loans, and there's some concern that the RBI has also been raising on the MFI loans and the NBFC loans.
Hmm.
So, if those, to a certain extent, if the credit risk assessment of the borrowers is something that the RBI is critically driving the financial sector into, and if loans that are being put out into this segment actually weakens, that can definitely have its implication for the rural growth very clearly.
Okay, so I think we'll take that sort of as a takeaway from the perspective of government-led sort of consumption boost. Perhaps those sectors will still find some steam, but we'll keep sort of taking these economic views as again we'll reconnect with Mr. Indranil Pan. But sir, as always, thanks a lot for coming on our show and
Thank
helping
you very
us
much.
understand this big surprise in the GDP growth numbers.
Thank you.
And with that, dear viewers, thanks a lot for watching us. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.